Every trader has been here. 6 losses in a row. 7, maybe 10. You sit down at your desk in the morning and there's this weight already on your chest before the market even opens. You second guess your entries. You exit trades early. You take trades you shouldn't take because sitting still feels worse than doing something. You tell yourself it's just variance. You tell yourself your edge is still there. But a quiet voice in the back of your mind has started asking a question you don't want to answer. What if I'm just not good at this? Here's what nobody tells you about losing streaks. Most of the advice out there is about surviving them, about protecting your capital, about not blowing up. That's important, but it's only half the picture. What nobody actually teaches you is how to read them. Because a losing streak is not just a thing that happens to you. It's a signal. It's data. And buried inside that streak, if you know what to look for, are 7 specific signs that tell you the streak is close to ending. Not because the market got easier, and not because you suddenly fixed your mindset, but because the conditions for a real turnaround are already in place. Today, I'm going to show you exactly what those 7 signs are, how to recognize them in real time, and why most traders miss them entirely because they're looking for the wrong things when they're in pain. Before we get into the signs, I want to tell you about Marcus. Marcus was a former financial analyst, spent 8 years building models for a mid-size hedge fund. When he left to trade his own capital, he was confident. He understood markets better than most retail traders ever would. He understood correlation, volatility, risk-adjusted returns. He understood the theory cold. In his first year of independent trading, Marcus had 4 losing streaks. The first 2 he handled well. He stayed disciplined, reduced size, waited it out. But the third one broke something. It started in October, and by December, he had dropped 34% from his peak. 11 consecutive losing weeks. He'd tried everything. Changed his strategy, went back to basics, took a week off, came back, lost again. What Marcus didn't know, what nobody had told him, was that by week 9 of that streak, 7 very specific things had already changed in his trading. Signs that pointed directly to a reversal. He couldn't see them because he was drowning in the losses, checking his P&L every 30 minutes, catastrophizing. He was looking at the scoreboard instead of watching the game. By the time week 11 ended and he started his first green week, he looked back and realized the turnaround hadn't come from nowhere. The conditions had been building for 3 weeks before the results caught up. He had been 1 step away from quitting the game at the exact moment the game was about to turn. That gap between when the conditions change and when the results change is what this video is about. Here's the fundamental thing you need to understand about losing streaks. There are 2 kinds. The first kind is a process problem. Your entries are wrong, your risk management is broken, you're overtrading or undertrading. You're trading a strategy that's genuinely stopped working. This kind of streak requires diagnosis and change. It won't fix itself. The second kind is a variance problem. Your process is sound, your edge is real, but markets run in cycles of efficiency and inefficiency, and right now the conditions that favor your edge have temporarily dried up. This kind of streak requires patience and discipline, not overhaul. The danger is that most traders experiencing a variance-based streak respond as if it's a process problem. They start changing things, they break what isn't broken. They overtrade trying to dig out, and then they turn a streak that was 3 weeks from ending into one that runs 3 months. The 7 signs I'm about to show you apply specifically to variance-based streaks. Streaks where the process is intact and the market conditions are the variable. Learning to identify which kind of streak you're in is itself one of the most valuable skills a trader can develop. Sign 1. Your losses are getting smaller. Not your win rate, not your number of profitable days, the actual size of your losing trades. When you're in a genuine process problem, losses tend to grow over time. You widen stops, you revenge trade, you hold losers hoping they turn. The losses compound in size even when they don't compound in frequency. But when your process is intact and you're approaching the end of a variance streak, something specific starts happening. You stop fighting the losses. You start accepting them faster. The average size of each individual losing trade quietly shrinks, even if you're still losing more often than not. This is not a mindset shift. This is a measurable, trackable metric. Go back through your last 30 trades right now, not your win rate, your average loss size compared to your average loss size 30 trades before that. If your losses are getting smaller while your process is unchanged, that's the market telling you something. Your execution is tightening under pressure. That's not what breakdown looks like. That's what readiness looks like. Marcus had this exact pattern. His average losing trade in weeks 1 through 5 of his streak was $2,200. By weeks 9 through 11, it had dropped to $1,400, same position sizing, same stop placement. His brain had stopped fighting the losses and started accepting them. He interpreted it as defeat. It was actually calibration. Sign 2. You're stopping out at the right levels. There's a specific kind of pain that comes from being stopped out and then watching the trade go in the direction you originally anticipated. It's maddening. It feels like the market is personally hunting you. And when you're in the middle of a streak, this happens constantly, or at least it feels like it does. But here's the distinction that matters. Are you getting stopped out because your stop levels are wrong? Or are you getting stopped out because your timing is slightly off while your direction is right? These are completely different problems with completely different solutions. If your stops are wrong, you need to recalibrate your levels. But if your timing is slightly early and the market is validating your direction after stopping you out, that means your analysis is working. Your read on the market is accurate. The streak you're in is not about your ability to identify opportunity. It's about micro-level timing, and timing variance is the most temporary of all trading problems. Keep a simple log. For every trade you get stopped out on, note where price goes in the next 4 hours. If you're getting stopped out and then price goes your anticipated direction more than 60% of the time, your edge is alive. Your entries just need refinement, not replacement. That distinction could save you from abandoning the exact strategy that's about to start working. Sign 3. You're bored between setups. This sounds like the opposite of a positive sign. But stay with me. When traders are in genuine distress, when a streak is breaking them psychologically, they become frantic between setups. They check the charts constantly. They look for reasons to trade when their conditions haven't been met. They force setups. The frenetic energy of desperation doesn't take breaks. But when a trader's process is stabilizing, something quieter starts to happen. The compulsive checking slows down. You set your alerts, step away, and wait. Not because you don't care, but because you've stopped trying to manufacture outcomes and started trusting the process of waiting for your conditions to appear. The boredom between setups is evidence that you've stopped fighting the market and started working with it. Anna was a Forex trader I know who had a brutal 6-week stretch on the pound. 14 losing trades across 2 pairs. By week 4, she described something she felt guilty about. She said she'd started getting bored during the day. She'd check her charts, see nothing was there, and go read a book. She thought it meant she was giving up. 3 weeks later, she had her best month in 2 years. The boredom wasn't disengagement, it was discipline finally taking hold. Sign 4. Your journaling is becoming more specific. Most traders journal when things go wrong and stop when things go right. But the content of your journal during a streak tells you something critical about where your head is. In the early stages of a losing streak, journals tend to look like this. Bad trade. Got stopped out again. Didn't follow my plan. Need to be more disciplined. Vague. Emotional. Self-critical in ways that don't produce information. This kind of journaling is a symptom of reactive thinking. You're processing the pain, not analyzing the data. But something shifts in traders who are close to turning the corner. The journal entries become specific. Entry was at 1.2840, stopped at 1.2810. Price reversed from 1.2795. Stop was 15 pips too tight for the current ATR. Adjustment needed. Widen stops by 20% on high volatility sessions. Clinical, precise, unemotional. Not I need to be more disciplined, but here is the exact mechanical adjustment this trade required. When your journaling crosses from emotional processing to technical analysis of your own behavior, your brain has made a critical shift. It's no longer in survival mode. It's in problem-solving mode. That shift precedes the results changing, not the other way around. Sign 5. You're sizing down without being told to. A lot of risk management advice tells you to reduce your position size during a losing streak. That's correct. But there's a difference between reducing size because someone told you to and reducing size because it feels right. Because something in you naturally gravitates towards smaller risk. During the streak, not out of fear, but out of clarity. The traders who are most dangerous to themselves during a losing streak are the ones who keep their size the same or increase it trying to make back losses faster. The traders who are approaching the end of a streak without knowing it often do something counterintuitive. They voluntarily go smaller, not as a defensive reaction, but because they've internalized that the current environment requires a lighter touch. They're reading the market correctly even if the trades aren't working yet. If you've found yourself naturally pulling back on size, not out of panic, but out of a calm recognition that now is not the time to swing hard, that instinct is calibrated. The market will eventually align with your analysis, and when it does, you'll still have enough capital to capitalize on it. That's not retreat, that's positioning. Sign 6. Your setups are appearing on schedule. Your edge, if it's real, is tied to specific conditions, specific price structures, specific times of day, specific volatility environments. One of the clearest signs that a streak is variance-based rather than process-based is that your setups keep appearing exactly when they're supposed to, even while the results are poor. Think about what it would look like if your edge had genuinely stopped working. The setups would either stop appearing entirely or they'd appear in the wrong conditions. Degraded, off-pattern. But if your setup criteria are appearing on schedule, the same patterns you've always traded, at the same times, in the same conditions, and they're simply not resolving in your favor right now, that's a market rhythm problem, not an edge problem. Markets have cycles. Trends, ranges, choppy transitional phases. Strategies built for trending markets underperform in tight ranges. Strategies built for volatility underperform in low volatility compression. If your setups are showing up correctly but not resolving, the question is whether the market phase has temporarily shifted against you, not whether your edge has disappeared. Document it. Track not just whether trades win or lose, but whether the setup criteria were met and whether the post-trade price action was consistent with your thesis at all. If your thesis is regularly right but the timing or the macro phase is the variable, your streak has an expiration date. Sign 7. You've stopped asking when it will end. This is the hardest sign to see from inside it. But it's the most reliable. Early in a losing streak, the dominant question is, when is this going to stop? You look at your drawdown chart and try to extrapolate. You calculate how many more losses you can afford. You set mental deadlines. If I don't turn this around by the end of the month, I'll take a break. The mind tries to force a timeline onto something that has no timeline. This is the brain in scarcity mode. But something shifts in traders who are close to the end of their streak. The question changes. It stops being, when will this end? And starts being, what is this showing me? They stop trying to predict the streak's duration and start trying to extract information from it. The obsession with the endpoint dissolves and gets replaced with something that looks almost like curiosity. Not about when it will be over, but about what the market is actually doing right now. Marcus told me later that by week 10, he had stopped checking whether he was still in a streak. He'd just started showing up, executing, documenting. The streak had become almost academic to him. He stopped caring when it would end. And that week 11 losing trade was the last one. Not because he fixed his mindset, because the process had stabilized and the market cycled back into a phase that rewarded it. Here's the thing nobody will say directly. You cannot force a losing streak to end. You cannot grind your way out of it or think your way out of it. What you can do is maintain the integrity of your process so that when the streak ends, and it will end, if your edge is real, you're still standing, still sharp, still solvent enough to capture the opportunity on the other side. The 7 signs are not a prediction system. They're a diagnostic. They tell you whether the conditions for a turnaround are already in place, even when the scoreboard doesn't show it yet. Losses getting smaller. Stops placed correctly. Boredom between setups. Journaling turning specific. Size coming down voluntarily. Setups appearing on schedule. And finally, the release of the obsession with the endpoint. When you see 5 or more of these signs in your own trading, you're not in a spiral, you're in the final leg of a variance storm. And the weather is already changing. Marcus came back from that 11-week streak to close the year up 18%. Not by changing his strategy, not by overhauling his psychology, by staying in long enough for the market to cycle back to him, with a process intact enough to take advantage of it when it did. The streak didn't end because he wanted it to badly enough. It ended because the conditions were always going to reset. And he was still there when they did. Your job isn't to end the streak. Your job is to still be in the game when it ends itself. That's the difference between the traders who make it and the ones who don't. Not talent, not capital, not intelligence. Just the patience to read what the streak is actually telling you and the discipline to stay in long enough for the data to be right.